if you have this type of aggressive goal, starting with $250,000, wanting $10,000 monthly cash flow, and you need over 40% annualized return, then that's the approach I would take if I were you, because that is that gives you the opportunity to buy a value add apartment building, implement the business plan, and then do a cash out refinance, and or get a supplemental loan, whatever you need to do, and then get your money back out and then put it into something else, or sell it and then 1031 into something else in 2 years, so that you've basically doubled in size or almost doubled in size within the 5-year frame. That's possible, and that's your a very reasonable scenario. However, there's a catch, and the catch is that there's more risk involved. And the reason why there's more risk is that you're starting a business, and anytime you start a new business, whether it's real estate or you're selling paper clips on the street, there's a learning curve, and you've got to figure out the right process. You've got to figure out the right team members. You've got to figure out what you're good at, what you're not good at. And if you don't know exactly what you're good at and what you're not good at as it relates to buying and managing an apartment building, then you're going to find out, and it's going to cost you money when you find out. So in my opinion, there's more risk involved with buying your own and taking the value add approach, because we're not just buying a stabilized property in this scenario. We're buying a value add deal. So not only is there risk with just buying a building, but there's risk in implementing a business plan that adds value to a property and then increases the rent. So you've got to watch, your occupancy. You got to watch where your rents are relative to the premiums you projected. You've got to watch your construction crew. You got to watch your property management company if it's not the same company. So there's a lot of different variables in play, and there's a lot more opportunity for you to lose money. But the question wasn't, what is the what is the best investment for me? The question was, or the statement was, I want to maximize our cash flow. Well, actually, no, they did say, I want to maximize cash flow while keeping our risk and headaches to a minimum. Well, in that case, I recommend the syndicated approach, because they are, by plugging into a system that has already been established, they're basically investing in a business that has already shown that it has a track record. So it likely won't have the type of returns that you could get if you were to buy a 30 unit, but from a risk mitigation standpoint relative to returns, I believe that's the best approach. But if you are purely looking for the most money and you're okay with more risk and more time involved, then I believe buying a 30 unit or a 40, 50 unit, whatever you can buy with the 250 while having operating capital and reserves to then do the CapEx projects and then still have money to cover the mortgage should unexpected dip in occupancy happen, then I recommend buying the 30 unit if you're okay with greater risk.